Hey, everybody. Welcome to today's 107th running of the Bulls. 107th week of this, man. Can you believe it? Hey, we've got some cool things to talk about. And by the way, today's sponsor is Opkala. They take the SH out of IT. Now, that is not their tagline, but we heard that last week. And I thought it was the funniest thing I'd ever heard. But they are a solution neutral IT advisor in helping businesses find the right IT solutions for them. And I love that company. One, they're friends of ours, but two, I like the fact that they are not pushing a particular brand or product. They are solution neutral and they get paid by whatever supplier you ended up choosing. So I think that's pretty cool. It's a pretty cool business model. So anyway, Opkala, Aaron Bach, and all those guys. You know the drill. Hit us up on Q&A. We have some polls for you today. That should be fun. Hopefully you got your taxes filed or you got extensions filed. We'll talk a little bit about that too. And I know that Jack and Adam have some rants, and Jack has the subliminally overt. It's interesting. The graphic that I created for this week's seminar just happens to, file and crop perfectly. So just the shoemaker logo is showing in Jack's background. So you'll see that. And then Adam has got our themed background, which is really cool because he's taking this call from the car outside of a lunch appointment that he's going to have to be at uptown. So that works great. So let's start with Adam. I'm going to put you on the spot. Any rants or raves right now?
It's all bad, Gary. It's all bad. No, I'm just kidding. Again, kind of who knows what's going to go on with tax rate increases potentially based on how the congressional elections are going to shape out. But I would say, vote early, but don't vote often. So just a reminder that, in North Carolina, at least, I believe some of the primaries are coming up in May. So just, get out there and cast your vote, because that's going to help dictate, kind of what happens in the beginning in terms of tax rate and law changes. But, probably, one that did come up that we talked a little bit about last week was the Secure Act 2.0, which is the retirement planning savings bill. I feel like it hasn't passed the Senate yet, but I don't see any reason why it's not going to, considering that, for like the first time ever, this bill passed, like, I'll get the math wrong, Jack can fact check me on it, but it was like 435 to 8, in the House of Representatives. So this was really bipartisan. So I know that he's not on because I just checked participant list, but it was really funny because one of my more staunch conservative friends was like, another government overreach. This is all terrible. Blah, 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 blah. I'm like, I don't know. It was 435 to 8 that it passed. So one would assume that the Senate version will also get equal bipartisanship support. But, what it really means to the folks that are on this call is that if you didn't already have a retirement plan, and I believe it's, you're below 100, I can't remember the employee count off the top of my head, but pretty much it's targeting pretty much all small businesses. And I think it might be everybody now that I think about it. You have to have a retirement plan. That's, kind of I don't know if I'd say it's a downside. What I would say is that retirement plans have a cost. Those costs come in two forms. One are just the pure administrative costs. You pay a third-party administrator, which, are typically, $1,500 to $2,500 a year in terms of the administrative costs plus tax return you have to file. And then the second cost is something that typically the employer doesn't pay, the participants pay, they just don't really know that they're paying it. And that's the fees paid to the person that's actually, managing the funds themselves, like John Hancock, or, if you're using, Merrill Lynch, or, and they're using John Hancock funds. I mean, there's fees associated with that too, that usually equal, maybe like 0.25% or somewhere in that range. So there are some costs. The other side of that, though, is that the government is also offering a tax credit for 3 years, as you implement it, as a way to defray, which from my take looks like it's going to pretty adequately defray any costs you're going to have for at least 3 years while you get the thing up and running. So, my general advice on retirement plans for employers is that, they are a good idea. I got the same frustration that everybody else has, on the call, that, the employees really, would like cash, not, not retirement. They don't appreciate it, blah, 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 blah. I get all that. We get the same thing at BGW CPA. I mean, up until recently, we're CPAs. We should all know better, right? We have the best Cadillac 401k plan you can have on the planet when it comes to safe harbor match, which should mean that if everybody was participating to the fullest extent possible, BGW would be matching 4% of their salaries. Yet our effective match rate was 2%, which means that there were a lot of people that were not fully participating, even though BGW was giving away free money. But if I just, use, someone on this call as an example, and it's not Jack, if you look at that, Gary's coming up on his third year anniversary. Love it that you've stuck around for this long, Gary. If you look at the value, of that match over that 3-year period, and the fact that, it's got a value, and that value in and of itself, just from simply being in the market, has doubled. That's actually a really good benefit that, employers don't broadcast enough. That's a big deal. I mean, if you got a 401k plan with a safe harbor match, I got it that people would love to have the cash, but at the same time, that cash isn't going to double in value. So like, I don't know this for a fact, but I would suspect if Gary did the analysis, as the rest of the BGW employees would do, and all of you guys would do that are on the call, if you looked at what's been the value of the match over the last 3 years in terms of what was actually contributed, plus what happened with the market growth, it's probably pretty close to double, depending on how it was invested, so that, so if I was to flip that script again and say, look, this is like that classic child psychological experiment, right? You can either have one candy now, or you can have an entire box of candy if you just simply wait 15 minutes. This is like an actual child experiment that they did back in the 60s, when you could experiment on children and it was considered ethically okay. Like some kids took the candy, ate it right away. Other kids just looked at the candy and waited for the bag. I mean, this is one of those, the bag of candy. And once you actually get the bag of candy, you're like, that's awesome. I'm really happy that I got the bag of candy instead of I ate that one freaking chocolate. It looked like whatever the fat chocolate eating kid's name was in Willy Wonka and the Chocolate Factory when he fell in the water. So that's Jack Starbucks trivia question for the day, by the way.
Yeah, the only thing that I'll add to that, since you're using me as an example, I'm not real happy that 100% of our 401k was invested in Netflix. I'm just, with that kind of plummet, I'm kidding. Yeah, that's good. That's good. Hey, and before I throw the rant over to Jack with the subliminally overt background that just shows Shoemaker logo, we do have a question in here that I think is pretty good. So this is from Brian. I've got a question about a service that my company offers. We offer advisory services for small businesses who accept credit cards in an effort for them to reduce their cost basis by negotiating with processors on their behalf. If savings are achieved, we continue to monitor their account for any issues and split the savings on a 50-50 basis. My question is, would this service qualify as a consulting service and therefore be eligible as a write-off for the merchant?
So in this case, no, because there's no economic substance to the transaction associated with the merchant, which I'm assuming in this case is actually the person that's accepting the fees. In other words, like that's sort of like, I mean, another way to put that would be, if I donated, I'm trying to think of a good example, but if you didn't spend the cash, you don't get the deduction. Like there's very few portions of the tax code where if you spend the if you don't have to spend cash to actually get the deduction, and they're very few and far between, and this is not one of them. So in this case, all you really did here, I mean, it's a good benefit, right? Because this could add up to a lot of money for people. But all that really happened here is the person now has a reduced expense number, which means they have more bottom line, which means they actually have to pay more taxes.
All right, good. All right, Jack, I know you got something on your mind.
Let me back up a second. So, in that, yeah. So in that scenario, yeah, the person's actually getting paid by the consulting company actually is getting paid by the card processor, not not the actual company. So let me back up again and use like a real world example. If Gary is the consulting company and comes in and says, hey Adam, I can totally reduce your merchant processing fees by $100,000 next year, and I want half the savings. And the way that's gonna flow is you're gonna get a new contract with a whole new processor, and I'm gonna have to pay, and instead of paying 100 grand, let's say my total costs for the year were $300,000, and now they're gonna go to 200. So I saved 100. But in exchange for that, I'm gonna have to pay Gary 50. I really have $250,000 in expenses, whereas before I had 300. So in that scenario, it is deductible. It's just that extra 50 that were the cost savings that I'm getting. I don't get to deduct that anymore. That's really just income.
All right, so Brian, let us know if that answered. So he added a couple caveats here. The consulting company is paid by the merchant.
Yeah, the 500. Sorry, other people can't hear the question. I'm sorry, Gary.
Yeah. So the consulting company is paid by the merchant, and they save the merchant $1,000 a month. Once that savings realized, then they invoice the merchant for $500 a month.
Yeah, so the $500 a month would be a deduction.
The $500 a month would be a deduction
that they're paying Brian, but not the other 500. That's the real savings.
Okay. Brian, hopefully, all right, great. We answered. Good job, Adam. All right, cool. All right, Jack, you have been waiting so patiently, and you've just been so good. So you got the mic.
Well, the reality is I haven't heard a word that Adam said because I've been trying to resize this photo in the background to get it to the right place. So I'm gonna have to listen to the recording to figure out what. No, I'm kidding. Well, I'm not kidding. I was actually doing both. I was multitasking, trying to figure it out. So just imagine the BGW logo right above the Shoemaker logo. Burn that in your minds. All right. Surprisingly, I don't have any rants this week. It's been, with nothing really going on. I should say, with respect to any money that's floating out there that you can potentially grab, or other than filing taxes. And there have been some issues, which I think we'll talk about in a few minutes, about late filings and disputes with respect to earnings potentially, if we're going to talk about that later today. But other than that, it's been kind of quiet. So Yeah, let's go.
All right, cool. Well, I know you do have something to talk about that. So we're going to go ahead. Anybody have any other questions? Brian, those were great questions. Thanks for bringing those up. I'm going to hit a thematic or time sensitive question first in the poll. So this applies to you, whether you're running a company or you're part of a management team, or you're just on here because you like, all of Jack's backgrounds. So here is the question. Tax filing, which describes your situation this year. You filed on time, you filed an extension. Wait, you mean we have to file taxes? These will be anonymous, so even if you're in the last category, you don't have to worry. Okay, you guys moved quickly. All right, cool. So you filed on time. 36% of the audience says you filed on time. 64% filed an extension. That makes sense, especially if you've got a whole bunch of K-1s. Also, if you were tied up in the delay of North Carolina getting their e-file system up and running, which it took them an extra 6 weeks to get it ready or something crazy like that. So I'd be curious too, if anybody wants to hit us up on the chat, if you filed early and on time, like I did, because my stuff was pretty simple this year. I still haven't gotten my North Carolina stuff, and yet I got Fed refund back in 2 weeks, and I filed in early February. So
can I share a dumb dad thing that happened this week to me, which is
yes.
Having a young adult who made some money over a summer job and was filled out the W-4 and therefore received a W-2, kind of put it in my tax stuff and didn't even think about it. And I'm like, okay, well, he's a dependent, and so no, he doesn't owe taxes, obviously. Then it occurred to me, wait a minute, there's a standard deduction. There's no way he made enough money to even get to the minimum. He didn't earn any, I don't know, it's inactive income or basically passive income from investments and things like that that exceeded whatever the dollar amount is, which is actually a low threshold. It's like $1,600 or something. So anyway, long story short is he should be getting some money back if I suggest to him that he files his 1040, which is very easy to do once I gave him back his W-2 form. So some free money for your teenagers if you hadn't thought about that. And so we're going to get him some free money, and then he's going to take me out for my birthday. So it's all good.
Make sure he takes you someplace nice and doesn't cheap out on you.
Yeah, I'd I kind of going back to the poll. I mean, that kind of follows the general. It's within a couple. That's within. If there was a margin of error on a statistically viable survey of plus or minus, 5%, that actually follows the national average. In terms of the people that file on time versus not, when you isolate that down to business tax returns. But the with all that said, what I would say is that don't use that as an excuse to not have your crap together. Like, your book should still be closed. You still know what you owed, and don't use it for an excuse to procrastinate. So.
And for those of you who missed my colleague a couple of weeks ago, the admissions of or confessions of a former IRS agent, and this continues to be a question on people's minds, that is there some sort of tactical advantage for filing late because they have to hurry up and get to it before the next tax season or anything like that? And what was shared with us at that time was that, no, I mean, it's an algorithm that they use. And it's the same algorithm that they use whether you file in April or whether you file later in the year. And so if you're going to get tagged, you're going to get tagged. And so there's no psychological, well, I shouldn't say there's no tactical advantage. Psychologically, if it makes you feel better, then maybe you wait. If you're a procrastinator, then maybe you wait. But On the other end of things, it's like, okay, let's just get it done, be over with, and enjoy the rest of the year.
Yeah, right on. And you will make every CPA's life a whole lot better if you get your stuff done and it's buttoned up and it's not dribs and drabs or a shoebox on fire. The shoebox on fire, no. Okay, I'm going to do another quick poll. And I got some really good information on this. This was prompted by a conversation with a banker that I had yesterday about a mutual client of theirs that owns some restaurants, that started a restaurant right in 2021, I think, late 2020, early 2021. But here's the poll that I'm going to throw up here, or launch. I'm not going to throw it up. I'm going to just launch it. ERTC. Has your company checked into the eligibility for ERTC? Yep, we qualify and we're getting money. Yes, but we don't qualify. No, what the heck is ERTC? And no, we're not interested in free money. Okay, good. And if you don't know, that's why we're asking the question, because there's some cool stuff that's available. And there's a provision. I just got some information this morning based on that conversation with this banker that I'm anxious to give you a highlight, and then Adam can go deep on it. So anybody else want to weigh in on this? So we've got 30% of the audience does not know what ERTC is. So that's okay. That's why we asked the question. 30% qualified and got money or are getting money. I'd be curious, if you got money, have you qualified to get money? Have you actually received the money? I'd be curious. Hit us up in the chat if that's the case. And yes, you've checked it, but you don't qualify. All right. So here are the results. Sharing those with you now.
Yeah.
All right.
So I'll go ahead and, hopefully address all three of the things that people responded to. So the employee retention tax credit, was just another part of the COVID stimulus packages that came out that basically said, if you've had some kind of disruption. So PPP was no questions asked, here's the money. That was round one, if you have employees. PPP round two at least had a qualification criteria, which said you had to have a business disruption to qualify for round two. Well, the employee retention tax credit was for all those people that, for whatever reason, weren't going to qualify for the employee retention tax credit, that were still small businesses, or for PPP that were still small businesses, or otherwise, PPP was just not going to be enough to get them through the storm. So it's basically, in 2020, $5,000 per employee. And then in 2021, up to $14,000 per employee of free money, if you meet the qualification criteria, which really, are two, one really easy category, one really more difficult category. So the easy category is, if in 2020 on a quarter by quarter basis, you had more than a 50% reduction in revenue, meaning like, quarter two 2020 had $1 million in revenue. If I compare back to the preceding quarter in 2019, so quarter two 2019, I was $2 million in revenue. Clearly I had a 50% reduction. I qualify. Same sort of criteria for 2021, but comparing the 2021 quarter, still the same quarter in 2019, same revenue reduction. Only the same revenue reduction criteria, only this time it's 20%. So that's the easy criteria. The more difficult criteria is associated with hey, I don't meet the revenue reduction test on a macro perspective, and you guys can't see me hold my hands up, but I do meet it on a micro perspective. So a good example of this would be, a restaurant due to a government order. So a restaurant due to a government order had reduced capacity, period. No ifs, ands, or buts. They were told, first off, no inside dining. Second off, even when there was inside dining, you could only have so many tables within your place to ensure some spacing. So their capacity was restricted. Regardless of what their sales were, because their capacity was restricted, they qualify. One that I'm really, happy with that, kind of fell in within the BGW client base, and restaurants are no brainer, but and this would be right up Jack's alley, personal injury lawyer. Even though the revenue test was not met, the courts were shut down. So cases could not be adjudicated for a period of time. So that business fell off a cliff because the court was shut down. It created a disruption due to the court shutdown. They could not go into their place of business to do work. So they qualified because of that and got a pretty significant chunk of change back. I think in this particular client case, I mean, it was about 400 grand. I mean, it was a lot of money. So as I said, that's the second version. That's a little bit more difficult, but it's still pretty specific. It's like direct government order. It can't be like a pseudo, hey, because, the government said that you couldn't be in a convention center, and BGW, you guys could have gone to a trade show and try to get some clients, even though you've never gone to a trade show in the past. You qualify, everybody gets a prize. It's not like that. That's pushing it, in our opinion. It's got to be something that you can kind of prove that you had it in the past, and then you can prove that a government didn't allow you to do it now, versus this theoretical what if nonsense.
And I would say, just as a side comment to that, is that we've also experienced a situation and have sent clients to BGW because their soon to be or former CPAs basically said, yeah, there's really nothing we can do. Or we looked at it and there is just, you may get a little bit more money if we file an amendment or do certain things, but it's really not worth it. And they were wrong. And so you don't think that just because, I guess what I'm suggesting is that, do take another look. If you think that there may be some money that you left on the table, do go back and take a look, maybe get a second opinion. I mean, it can be a significant number of dollars that you may have left on the table because of an error. So it doesn't hurt to have a second look at some of the numbers that were calculated if you did file an ERTC claim.
So here's the scenario that prompted this whole question and another little nuance. Banker says, talking about a mutual client of ours that had started, they had an established restaurant. They started another one up kind of in the middle of COVID here, et cetera. And startup costs were high and revenues were low, even though they're doing quite well now. But in the conversation that they had with a group that we use for these ERC credits, he was told, hey, well, but wait a minute, there's this thing called the recovery startup credit that was part of the infrastructure bill. And here's what the deal is. So, and they qualified for this, but didn't, had been told before by their prior CPA, nope, couldn't do this or whatever. So here's the deal. Up to $50,000 in Q3 2021, you could get that amount, and up to $50,000 in Q4 2021, calculated at 70% of the first $10,000 in wages per employee, has to have started operations after 2/15, so February 15, 2020, and have under $1 million in annualized sales at that moment, even though this particular restaurant has more than that now. At the time, that was the case. So they had been told, no, probably don't qualify, but this recovery startup credit as part of that is interesting. So if anybody, especially if you're a client of ours and you haven't gone down that path, ping me. And even if you're not, we'll help you and we'll get you in touch with the group that we use. They're fully vetted and they're very good. So anyway, just let me know. My email is gfrey@trustbgw.com, and I'll get you through to Chirag and we'll get things moving. But again, we've outsourced all of that to this group called ERC Today. So, and they're here in Charlotte. So how about, and I do have a final poll question towards the end that's a tee up for, I think, next week, because I think we've got some cool stuff there. So I'm thinking of going into the grab bag of the 110 questions that we are most frequently asked. And I thought this would be kind of an interesting thing. If you own an incorporated business, here's the question. We see this all the time. What's the best compensation strategy? And Adam, this has kind of got your name all over it. Compensation strategy if you own an incorporated business.
It's a good question. The you really got two moving parts, and I'm going to speak first as the sole owner for a minute. So let's, the same thing can kind of conceptually apply if you're a multi-owner business, but in a single owner business, it's pretty generic. So, and I'll kind of walk through the evolution. So when you first start the business, you need to do two things. Take the lowest salary possible to defend with the IRS, because that minimizes the amount of taxes that you're going to pay for a variety of reasons. So, using real world examples, if you lost money, you are not going to get thrown in jail as the owner of an S corporation for taking a paycheck. It drives us crazy. We've had no auditor have that as a finding ever. It drives us crazy when we see S corporation, $150,000 loss, line one, officer wage, $150,000. It's like, you created the loss by paying yourself. You just paid a bunch of Social Security taxes you didn't have to pay. So that's number one. So what's the lowest defensible value? It's generally speaking, you're going to pass tax court if you're kind of in the 25 to 50% range of, total income. So if you made, $100,000, anywhere between, before taking the W-2, anywhere between $25,000 and $50,000 is going to pass tax court all day long. And you kind of can follow that same rule of thumb all the way up to the Social Security limit, which this year I think is $140,000 and some change. On an audit, we've never had someone say, take more than the Social Security limit, even if the company made millions of dollars. So then you get into, well, what would be reasons that I would want to actually take a real legit higher wage? It would go back to the retirement. Most retirement plans are gonna key off what'd you pay yourself. If you're an S corporation through a W-2, the distributions aren't going to count. Partnership, it's going to be how much did you earn, but subject to self-employment taxes, which is the same thing as a paycheck. So those would be reasons to potentially take more in a paycheck, is if you're going to be fully supercharging your retirement plan because of it. But even then, the statutory limit for the best, most Cadillac retirement plan on the planet is about 300 grand. Ergo, there's very little reason to take beyond that. And same thing applies if you're a C corporation, because when you look at like very few C corporations are going to distribute 100% of the cash that they make in any given year. So even in that scenario, you're better off coming up with a mix of what's the right W-2 versus what's the right amount to take in terms of a dividend, which gets you to a lower overall rate for that effective tax year for the cash that you end up taking out of the business. So all of that said, I know that was a lot of information. All this said, and Jack would definitely agree with this, is your time to shine, Jack. You know, you can't artificially, when I say you can't, it would not be wise to artificially inflate your profit or start beating yourself on the chest about how amazing you are. Because you took an artificially reduced wage, because that's going to come up in a transaction that as an adjustment that will not be in your favor if you've been taking an artificially low wage. So our advice, it's also fooling yourself. So our advice is that you should know what the market value of your role is. And for most the market value of a middle market CEO, middle market being, call it, couple million up to maybe 5-10 million bucks is going to be in kind of the 150 to 200 range. If you go higher, and then it kind of indexes maybe 50 grand for every million beyond that, based on the compensation surveys that we've seen out there. So you should know what your market value actually is, and start thinking about, even if you don't actually pay yourself this via W-2 on your P&L, think of it as an expense item, because that's what your replacement would be. If you're to replace yourself, that's what a buyer, when they come in and do a quality of earnings audit to determine the true value of your company, is going to impute as the salary, which is going to reduce your purchase price if you've had an artificially reduced wage. I mean, there's probably all sorts of, partnership legal dispute stuff that's related to that too, as well. So that's our general thoughts on wage, now that I've given Jack plenty of time to collect his thoughts on the matter.
So yeah, similar, it creates problems, and you're doing yourself a disservice by manipulating the numbers in that fashion. And so and you touched on it just in the last few seconds of what you were talking about, which is now dealing as the issues as between the owners. So now, you in your minds have this catch up down the road as far as what might be, if one person is leaving, or if there's supposed to be bonuses, or there's supposed to be payback of back wages, etc. The ladies and gentlemen's arrangement type of payback. And so it creates a lot of issues off the balance sheet that are going to have to be dealt with on the balance sheet. You should roll with what the actual value is, or close to it. Understandably, that may not be the case if there's just not enough cash around necessarily, but to create a loss that is equal to your salary. Yeah, I mean, it's very transparent, even if you think you're getting away with it. If not in the current moment, then down the road, whether it is the IRS asking questions, or an astute buyer and their counsel and their CPA saying, well, wait a minute, let's talk about this. I mean, and so, yes, that can create problems down the road. There's also, and as a side note, and I don't know how you guys feel about this, but one of my tax partners here believes that S corps are really have no place in modern day business functionality. And he's saying it in the context of down the road, what an investor might want, and not be held down to the S corporation restrictions as far as layering ownership in holding companies and things like that, in not being able to have disparate economics as far as distributions amongst the owners and things like that. So that's a topic for another day when we're talking about kind of M&A transactions. But so just be aware of those things as well when you are making let me say it a little differently. So when you're making a decision to open up a new entity and having a choice of tax election in front of you, you shouldn't just default to the fact that, well, I have two other S corps, and so I'm just going to do what I did before and file that S corp election. I'm suggesting that there be a deeper thought process into why you're setting up that company, what is in your future that may not have been in your immediate future 10 years in the past when you set up those S corps. So, they're just like anything else. Through the evolution of your business enterprise, there may be reasons to make different choices than it being the same as before.
Yeah, I mean, I kind of echo Jack's comments that, while we probably have had pure S corporation stock transactions in the past, I can't think of one. But what I can categorize that survived that way. I mean, all of them typically have an 83 or you know what I'm trying to say, 338H10 election that goes along with it, that treats it as an asset sale. So I can't, none of them survive. Like every transaction that involves either strategic buyer, or a private equity firm, which is kind of what we're hoping everybody can kind of shoot for, that S corporation doesn't survive. And there's always some sort of hoops or mechanics that you got to jump through pre-transaction as part of the reorg to make it palpable to acquire the S corporation. The reason for that is, as Jack pointed out, I mean, most private equity firms are structured as partnerships. S corporations cannot be owned by partnerships. They got to be C corporations, or they got to be other partnerships. So you kind of is what it is, people. That's the problem you're up against. I didn't make the rules. I just got to play by them. And that is one where, I can't win that argument. I know it says that specifically in the tax code that you can't do that, but maybe there's no loophole exists for this one.
So Jack, before we move on to another question, here's kind of the question for you, which you teed up earlier to me this morning. So what happens if there's a dispute as to taxable or allocated income to an owner or former owner, either by the employer or the employee? Can you go into that a little bit more?
Yeah, and so and I guess I'm in double dipping here, in that I get some free tax advice from you guys as well, because I was going to ask you this anyway at some point in the near future.
All right, Adam.
Right. All right. So the situation is, it's a medical practice. One of the owners has been improperly ejected from the business. Obviously that's my client. And so, but it's okay. They've worked it out. They're going to go their separate ways. There are some other issues, but one of the issues is the allocation of income, or the allocation of income that is showing up on his K1. And we're in one sense, we're like, okay, well, we want to see what the actual income was total and all the expenses and everything else. But on the other side of it, it's like, well, wait a minute. For the past year that we've been in dispute in 2020, he hasn't been working for that entity. So how did this income get allocated to him? So it's kind of like, we want to see it both ways. It's like, if there's a ton of money, then we want our fair share of it, because it was built on the goodwill of this group being together. On the other hand, it's like, wait a minute, if he's not working, how did he get attributed this? Well, it's a partnership. But so the issue was, well, here we have to file, the client has to file their personal income taxes, but is concerned that this K1 is incorrect. And whether, and this is more of a legal issue, the legal side of it, which is this an admission as to the validity and the correctness of that K1? But the other question is like, okay, now what do you do? Do you file it and then maybe have to go back and amend, or do you basically not file it And my solution was, well, let's kick the can down the road and wait till the fall, see if we can work it out until then. But, let's say that this still is an issue in the fall when they have to file, they got their extension. So what literally happens in that instance? And then there's another story, which is a client had an employee that they terminated. The payroll company they kept the spigot going, and the client employer didn't realize it. Obviously the employee was like, okay, I'm not going to tell anybody. Taxes were withheld. And so this is more of a W-2 issue as to, okay, is there an admission? Again, this is the legal aspect of it. Is there an admission that if we issue this W-2 showing all this money that was actually given to this employee, does that create a problem of precedent that maybe there's an admission that, and then you can't get the money back, or do you wait? And so at this point, the W-2 has not been given to the former employee until we resolve this issue, and we're trying to get the money back, which is difficult because at one point this person was in North Carolina and now is a resident of the state of Florida. So two similar issues, but from different perspectives. But ultimately the question is, what do you do when there's a discrepancy between what is actually the current status of what should be reported on a W-2 or a K-1 versus what might be the actual outcome once these issues are resolved?
Yeah. So on the K-1, there actually is a form that you can file. I believe it's a form 8082 or 8802. I can't remember exactly which one, but it basically says, I dispute what was on the K-1 that I was issued. So like in Jack, in your specific instance, I mean, if you're gonna file, they should also file that form, because it will allow them, it at least puts on record a dispute with the IRS. They followed every step, that they needed to follow to dispute, the K-1 value. So it's rare, but it does that we've seen, but it does happen.
Okay, good. What about a disputed W-2? Do you have any guidance on that?
That one, I think there is something you can do on that one. I just don't know that one off the top of my head.
Okay.
But I mean, if they actually got the cash, I would think they would probably report it. And then if they got a corrected W-2 and asked for if they got the correct W-2 and got the cash, they should probably report it. If they're then subsequently required to give the cash back, they would amend it and presumably get the cash back. So that's a doozy.
Yeah, it is. All right.
Whew. That sounds messy.
Yeah.
Yuck. Comment from Lonnie. This has been informative. Is there a place to view these past recordings? Absolutely. Go to just Google or go to YouTube and find BGW CPA. And we have a YouTube channel, and all 107 weeks. And there's actually more than those recordings, because some of those weeks early on, we were doing 2 per week, Tuesdays and Thursdays. Gosh, we did that, I think, the first 3 months, something like that. So anyway, there's a treasure trove of fun and frivolity in there. So anybody that cares to go see that. I think what I'm going to do is I'm going to do a tee-up poll for what I think should be a really good, interesting discussion next week. So let's stop sharing this and let's go to the next poll. Succession planning. So here's the question. I'm going to go ahead and launch it. What best describes your situation? I have the succession plan for my business completely in my head. You wouldn't believe how many people have that. I have a written plan and my key members of my team know about it. 3, I'm in process of actively doing my plan with my advisors. 4, I know I need to do it, but either I don't want I don't know what to do, or I'm procrastinating. And then the last one is I'll let somebody else sort through the rubble once I'm gone. So this is encouraging. Keep voting. Wow, somebody actually has a written plan and their key members of their team know it. That person should get a Starbucks credit card from Jack. So keep voting, and I'm going to close this poll in about 30 seconds. How about that?
And I would be
Anybody
happy to
else?
do that, because that is like the unicorn that it's like, wow, that person really has their act together and very much appreciated. It doesn't generate as much attorney's fees and maybe CPA fees, but I would much rather it be organized and then implementing the plan, and you spending your money implementing the plan rather than trying to organize it.
Yeah, I hear you. So whoever, since these are anonymous answers, if you want, and you want a Starbucks card credit of Shoemaker with the subliminally avert background on Jack's, hit us up in the chat and let us know how we can get that, who it is and how we can get that to you. But so we had a low participation. I'm disappointed actually on this. So last call. All right, we only had 4 people weigh in on this, but here are the results. Half of you in process of doing it. Good job. You need, if you need, you need to do it. Let's get it out. But don't know what to do. That's why we're going to be doing this next week, I think, because there are we've got some really good questions that we've asked in the past. It'll be interesting to see how this group lines up with the results that we've gotten from past polling with a pretty big sample. So I think if you guys are cool with that, let's go into that deeper next week.
Yeah, and a teaser for that too is anticipating the unexpected, but it is a high possibility of it being expected. And I'm talking about that you have everything kind of sort of planned, but then an intervening divorce, remarriage, death of a co-owner. And then it just throws, all things into a maelstrom of trying to figure out what is going to happen. So, and we get this a lot, which is, yeah, I know what's going to happen. It's okay. My kids get the business ownership interest. Well, my spouse does, then my kids get it. And it just kind of just falls the way it's supposed to happen. Kind of in, biblical sense, which is that, okay, each kid gets 1/2 and life goes on. And there are just so many intervening factors. And then also just efficient tax planning. So there's the legal side of things, and then there's the tax side of things where people would they put their heads in the sand and like, okay, well, they'll just let it happen. And not taking advantage of potentially lifetime exemptions. And it is very much a difficult conversation to have, maybe from like a child to a parent, and say, you're getting up there in age, so let's talk about some efficient tax planning of maybe using some of your exemption capacity to start making transfers to your children, potentially grandchildren, that kind of thing, and doing the things that you are intending on doing after your death, but implementing them maybe now so that it's maybe more tax efficient. So things like that just, it's many times an aha moment when I have and like Stephanie Daniel in our office, or even Warren Keene, our tax guy, kind of go through some of this stuff. And it's like, oh, didn't know that. Yeah, that's a good idea. And then it does become, well, okay, the most difficult part of that is having that discussion with a parent or with a business partner that may be older than you, kind of thing. So there is also the psychology of it, and we totally get that. But all good things to talk about and kind of flesh out a little bit and maybe kind of give you a little bit of guidance into how you might handle some of those things in going into it with a position of knowledge so that you know what the options potentially are.
So here's a thought too. It doesn't have to be succession planning based on my exit from this earth. It could be succession planning based on, I want to go skiing, sailing, fly fishing, and golfing more frequently, or I just want to have a whole lot more flexibility with my time and lifestyle. And I want to know that the baby that I created called my company is actually going to be in good hands. And because I want the next generation of leaders and families that are impacted by this company to thrive. And I'm not just focused on me. Yeah, I mean, because we can run to stuff and not just run from stuff. And so what I've seen too is business owners that have taken the time to just get it outside of their head and really start working with an advisor that they trust on working through some of these issues. I've seen owners that are doing all the stuff that they love to do a whole lot more than just getting trapped inside the machine of their own company. And they have no intention of retiring, but if something happens to them or whatever, they know that it's taken care of. And right now they're living their best life. So just another mindset thing to think about.
And I think also, Gary, to have a backup plan, because it may be that, unintentionally, unexpectedly, that your plan is going in this direction. And then there's a life-changing event in whoever that successor is, whether for them or for a family member or, whatever it may be. So, and I think that for me, the key is to kind of know your surroundings, like know your business, meaning knowing the value of the business and then being able to kind of pivot. And I'm not suggesting you get a $10,000 a year formal valuation done every year kind of thing, right? I'm suggesting that, you just be aware of and in tune with the value of your company so that you may be able to pivot if you need to. And if it was that you thought you had a successor, but now you really have to, you're more towards putting the business on the market, even if it's just to test the market, then, kind of have that thought process at least going. And, you said it, have your office in order, have your back office in order. And that's the best way of doing it. And I think that, again, the psychology and the reality and the practicality is, do we really have time to allocate to dealing with the mess that's in the cabinet behind us, right? And, it just takes discipline to be able to do that. Again, easily said than done, but, it's just all these things that you do these things and hopefully you're in a better place down the road to deal with the zigs and the zags.
Yeah, if you think you got to do it all at one fell swoop, you won't do it. But if you are disciplined and you take one bite of the elephant a week, that's kind of the way to deal with it. So any parting thoughts before we sign off today, gentlemen?
I'm good.
Nothing. I'm good.
All right, everybody, thanks for joining us. We'll put this up on the BGW CPA YouTube channel later on today. Appreciate it. And next week, I think we'll go deeper into succession planning. See y'all.
All right. Thanks, guys.
Thank you.
Bye-bye.